a.m. in New York. Good morning. I'm Vonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. SALT talks. Senate Majority Leader John Thune says GOP senators and President Donald Trump had a positive discussion on the tax and spend bill. Countdown to the ECB, the central bank expected to cut rates for an 8th time as global trade uncertainties persist. And day 2 of Super Return. Don't miss out on our live interview from Berlin with 6th Street Co-CIO Julian Salisbury. That's later this hour. So let's get to the markets now. We have had 3 positive days this week. Barely positive on the S&P 500 yesterday. It held on to a very fractional gain. We have futures pointed higher once again today. Of course, it's all going to be about non-farm payrolls tomorrow and everything that happens in Washington, D.C. But so far, futures pointing to another 0.1% of a gain in this very, very early going, it should be noted. Nasdaq 100 futures too in the green, and we have Russell 2000 futures also up 0.2%. Lots of economic data later this morning that may have an impact on yields. Of course, we've seen yields move for all sorts of reasons. A big move, particularly for the 30-year yesterday. If you'll remember, we started yesterday with a yield of 4.98%. It was about to test that 5% mark. And then throughout the day, after the weak ADP data, and of course everything that's going on globally, we saw a move into treasuries and that yield down to 8.9593 now. We also didn't see the same move quite so much on the 2-year yield, but obviously that's going to be impacted more by the Fed. This is the picture I'm talking about. Look at that Japan 30-year yield. The auction that we saw out of Japan, not as bad as feared, if that's good news. Well, that yield at 289.20 right now. Remember, the high was at 318, so it looks like things might be improving in Japan. No more long-end yields, at least until the Bank of Japan meeting in 2 weeks, and also the Ministry of Finance is going to be meeting with traders, so that should calm things just a little bit. Now let's get to some macro movers, micro movers even, with Joe Easton in London. Joe.
Hey Vonnie, so one of these big movers today is PVH Corp. This of course is the owner of Calvin Klein and also Tommy Hilfiger. Weak results out of them last night. Doing a lot of discounting is what analysts are saying, and that is really not actually helping the sales that much. That's really extending or going to extend a big loss over the past year for that stock. We're down by around 30%, I believe, on a 1-year basis for that one. Then we move over to Five Below. This is more a value retailer, kind of in your stationery and toys and phone cases, anything you might want to pick up on the cheap. But that one is looking a bit better than expected, in fact, and the shares rising around 5%. The results were towards the top end of the EPS guidance. It's the main takeaway on that one. And then finally, in the tech and telecom space, we've got Verint. This is kind of in your communications, automated communications, going into call centres, that kind of thing. But we can see a really strong reaction to that quarterly beat on the earnings of Verint, up more than 20% today. And as usual, on the Bloomberg terminal, the before the bell opening wrap will summarise all of these moves and more ahead of the open in New York. Vonnie.
Joe Easton, thank you so much. And coming up, we're going to be speaking with Julian Salisbury of 6th Street. And we're going to be hearing from James Clarke of Blue Owl. That's all from the Super Return Conference in Berlin, so you won't want to miss those interviews. President Trump and Republican senators have discussed ways to scale back the $40,000 SALT cap. Majority Leader John Thune spoke to reporters after the meeting.
We had a very positive discussion about the path forward on the big, beautiful bill, on the reconciliation bill. And I think it was a reminder that we are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Meanwhile, Elon Musk is back at it again, posting on X, "Call your senator, call your congressman. Bankrupting America is not okay. Kill the bill." Joining us now is Bloomberg's Kevin Whitelaw. So, Kevin, it doesn't seem like we're getting anywhere faster on the negotiation, any kind of reconciliation between the parties. What kind of a time limit do we have on this?
Well, you know, the ultimate sort of forcing mechanism right now is the debt limit, and the exact time for where that debt limit is going to kick in is between sort of August, September, October, depending on the various estimates you're looking at. Now, the debt limit could be handled separately. They could try to do it separately, but that's a challenge to get the votes through as well. So they're really pushing, and a lot of the pressure is obviously coming from the president himself. He really wants this bill. He wants the things that it's going to bring. But it was always going to be a tough tough road. They barely got it through the House. They're going to have a lot of trouble getting it through the Senate. There's a lot of senators that want changes that are simply not compatible with each other. And so figuring out how they're going to get to a place that delivers on all the various promises, it's just not clear yet how and when that's going to happen.
Yeah, Kevin, it will be interesting to see how this progresses, particularly given that Elon Musk seems to be very much having a bee in his bonnet at this point and keeps on posting. But President Trump has also reinstated one of the most controversial measures from his first term. Have a listen.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
The audience for this is likely his base. Who else, Kevin? And will there be repercussions in the courts?
Well, you know, this was a version of the travel ban that he did institute last time, and the president does have some broad authority to do this, particularly when they're able to articulate a basis for some things rather than have it be sort of a blanket, sort of a total blanket ban. So he does have some precedent for being able to do this. There were 9 countries that he targeted in his first administration. This time it's 12, adding in a couple like Afghanistan and the Republic of Congo to the list. And so what this does is target essentially new arrivals. If you know, it doesn't target people who already have visas or an authorization to be in the United States, but it does make it very, very difficult, nearly impossible for people to get new visas from those countries. He's also doing sort of partial restrictions and bans on several other countries. So this very much follows the track we saw the first time. This does play to the base. They, you know, the explanation that Trump gave and that his team gives is that this is for security, this is for safety, and this is for, for what the United States needs to do to keep itself safe. Strange thing, of course, is he was citing this incident in Boulder, Colorado, this attack on these marchers that was carried out by someone who'd overstayed their visa. That was an Egyptian citizen, and Egypt is not on the list of countries that he targeted today.
Yeah, exactly. Hadn't gone unnoticed. Kevin, thank you so much. That is Bloomberg's Kevin Whitelaw. Let's switch focus now to Europe. The European Central Bank set to lower interest rates for an 8th time. Bloomberg's Lizzie Burden joins us now for a preview of what to expect from Frankfurt and, of course, ECB President currently, Christine Lagarde. So this could be the last cut, at least for now. What happens next? Walk us through the debate around what comes next and the forward guidance, Lizzie.
Thanks, Bonnie. Yeah, it could be the last easy cut from the ECB today. Easy because inflation in the euro area has now dropped below the ECB's 2% target. It's at 1.9%. But from here on out, the outlook gets murkier. First, in the short term on the tariff front, and in the long term on the fiscal front. We just don't know what the economic impact is going to be from all that infrastructure spending, the defence spending as well. Maybe we'll get a closer idea of from the NATO summit later this month. But because of all of this uncertainty, today we're expecting not just the updated forecasts on inflation and growth, but also a range of scenarios. And the question becomes, do they cut again in July, or do they wait the summer and go in September? Economists expect September, but the argument against that is that they could confuse the market. And that is the last thing that President Lagarde wants to do. The ECB says it wants to be a beacon of stability. It doesn't want to add unnecessary surprises in an already volatile market. So I expect at the press conference today she's going to be keeping her cards very close to her chest, but also, as you hint, on this question of her own tenure as president of the ECB. There's speculation that she's looking at becoming leader of the World Economic Forum, speculation that she hasn't yet denied. So we'll see if that pops up at the press conference.
I feel like she's definitely going to get the question right, Lizzie. Our thanks to you, Lizzie Burden will be following it all for us in real time, and she's there in Frankfurt. Now to other top stories trending on the terminal this morning. China says the new US tariffs on imported steel and aluminum will seriously disrupt the global industry supply chain. A spokesperson for China's Ministry of Commerce also said China's exports curb on rare earths is in accordance with the law and vowed further measures if the US doesn't change course on its trade policy. Citi is cutting about 3,500 tech employees from its workforce in China. According to the bank, the reductions are expected to be completed by the start of the fourth quarter. It's aiming to cut 20,000 jobs by the end of 2026 as it tries to streamline operations and lift profitability. Alphabet CEO Sundar Pichai says the Google parent company won't stop hiring despite advances in artificial intelligence. Speaking at the Bloomberg Tech Conference in San Francisco, Pichai defied the trend in big tech of trimming staff.
Grow from our current engineering base even into next year. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. People will be able to do more, which means maybe we'll create new products, and hence we will need more people, at least in the near term.
And coming up live from Super Return in Berlin, our own Danny Berger is sitting down with 6th Street Co-CIO Julian Salisbury. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Let's head over now to Berlin, where Danny Berger is at Super Return. Leaders there in private capital are all gathered for the annual summit. Danny.
Bonnie, thank you so much. I'm so pleased to say we have another fantastic conversation for you. It is Julian Salisbury of 6th Street Capital Partners, the co-CIO. Julian, thank you so much for joining this morning. Fantastic to see you in Berlin. Look, it's an interesting time, to say the least. And you overlook so many asset classes, be it at 6th Street, be it at your past at Goldman Sachs Asset Management. For private equity in particular, it's been incredibly challenging to fundraise. Is this an industry having a rethink, a reevaluation of private equity?
Look, if you look at the historic returns for private equity over 20, 30 years, they've obviously been very attractive. That's drawn in a lot of capital as people have looked to replicate the success of the early movers, the ultra high net worth individuals, the endowments. It's gradually over time drawn in a broader base of institutional investors, insurance investors, and more recently wealth investors, all kind of chasing those higher rates of returns. And that's, as that money has come in, it's, and you combine that with the low interest rate period of 2020 and 2021, you got a lot of, frankly, bad vintage assets. I think of it as like a big pig in the python. All these stuck assets that were originated when too much money came in, bought at too high prices, and it's indigestion, essentially. And this is going to have to work its way through over the next couple of years. It's one of the big themes we're seeing in investing right now, which is resolving these stuck assets. Assets bought in a different rate environment that needs to figure it out. The solution could come in many forms. A lot of them, people have been hoping that some combination of growth and interest rates coming lower was just going to bail them out. That pot of, that light at the end of the tunnel has been moving further away.
How painful does it look if we don't get that, though? Because at the moment, rates are still high.
Yes.
Growth looks challenged. How painful does it become?
Our belief had been that rates would stay higher, coming lower from where they are right now, but staying higher for longer, and we continue to believe that will be the case. A lot of inflationary pressure is still out there. So that exit, as you get further years into this, more and more funds reaching end of fund life, incredible pressure from LPs around DPI and returning capital. So as that pressure is building, it's really forcing people to take more action, and there are many kind of levers they can pull to generate DPI. But I think it is going to take longer, and that's going to force people to actually take some pain. One of the big themes, again, that we're seeing right now when we think about deals is you have to find people who need to transact. Because if people don't need to transact, their preference is wait, because they think there's going to be, it's always going to be better to sell tomorrow. So a big focus, whether it's in private equity, growth, real estate, across our infrastructure, across the different asset classes, do these people want or need to transact? End of fund life, transitional ownership, real pressure from their LPs.
So that's in private equity. There's also been some concern in credit that we're also in a period of extend and pretend. Jamie Dimon even recently said in the past month that credit risk is not appropriately priced in. Is he right?
So let's talk about long-term and short-term. I think if you think big picture, private credit as an asset class is a very nascent. People didn't even really use the term private credit 7, 8, 9 years ago. The big endowment model approach was private equity, and you want to own bonds, not even IG. You want to own government bonds. That's your kind of barbell portfolio. And as this has emerged as an asset class, I think people have taken real interest in it. First of all, important point, I think 85% plus of companies in the US are private companies, so they need access to capital that they can't get through capital markets. There have been very attractive historic returns, a real spread premium for that has pulled in institutional investors. In particular, as rates went higher again, just the nominal return on private credit was reaching a point where it hit their target rates of return for those funds. Now, what's happened over the last 3 years is, given the relative attractiveness of the asset class, it's sucked in a ton of money. We've seen a tripling of the market overall, tripling of private credit, and the vast majority of that growth has been like an 18-fold increase in direct lending over that same period of time. And in particular, in more recent years, a very large preponderance of that money, 70% plus of that money, flowing into evergreen vehicles. And the problem with those vehicles is when the money comes in, you have to invest it right away. So it does feel right now we've got this dual kind of pain point of a lot of like fast money coming in, combined with a relatively anemic M&A environment, so a relative lack of supply. So I think it's fair to say today, spreads in that market are not particularly attractive, but that can change very quickly. I think you're going to see a slowing down of some of those retail flows. You see a slight uptick in M&A environment, and that. So on a long-term secular basis, private credit is still very attractive. It's just right now there seems to be.
For now, does that also mean that managers are taking sacrifices, be it cov-light deals or spreads?
Absolutely. You're seeing again when money comes in the door and you have to put it out the door. We're designed differently. We design our liability structures such that they're either permanent in nature or truly permanent in nature. People describe evergreen as permanent. It's not permanent. Or they're drawdown in nature, which means in a period of time like first quarter of this year, when the market's incredibly tight, we can just fade and take a step back. And then at other points in time when things get dislocated, we can actually lean in and be far more aggressive. But I think, right now, a lot of pressure, but it exposes itself differently. I would say most acute large cap, straightforward, plain vanilla end of the direct lending market is what gets squeezed down, and people will push down both pricing and terms. At that point in time, you can pivot towards the smaller and medium end of the market, where you can still get some better pricing and some better structure.
Julian, I also have to ask you about some of your sports investing. A wide range from Celtics to Real Madrid to the San Francisco Giants. Where else are you interested in expanding into?
Look, we've been in the sports ecosystem for many years. You go back 5 years ago, we made a control investment in Legends, which really operates the concessions and retail units across stadiums around the world. That gave us real great insights and partnerships, starting with the Yankees and the Cowboys in that Legends investment. Off the back of that, we've made a number of investments since. We're very excited by the general theme of sports. I think people get confused about this stuff. They don't really appreciate what's going on. The step up in media rights that we've seen and can expect to continue to see in the coming years means that we're going to continue. These are going to continue to be viewed as very valuable assets. You think about live TV; it's basically news and sports these days. The way we've approached it, similar to the way we've approached other things at Sixth Street. It's not one cookie cutter where we do, one tool in the toolkit. Post the Legends deal, we did a partnership deal with Real Madrid, where it's a 20-year partnership where we invested in upgrading the Bernabeu Stadium. In the case of Barcelona, it was purchasing a share of the domestic media rights to provide them capital. In the case of Bay Area Football Club, it was a control investment in a women's soccer team.
Just quickly, I would love to get your thoughts, because the AC Milan owner has been very public in saying sports valuations are in a bubble. Do you think he's right?
Look, I think you have to really look country by country and asset by asset. It's so asset specific. The dynamics, for example, in the US, where you have teams with salary caps and high media rights and drafting systems such that teams are constantly rebalancing. You don't have promotion and relegation. You don't have, am I in the Champions League, am I not in the Champions League? it's a very different kind of risk profile to being in a European team where like making or breaking Champions League has a huge impact on the bottom line, and really you're competing. You have it's a much more kind of feast and famine kind of approach in European soccer.
By the way, your team Wrexham here, they're selling a stake.
My whole family's from Wrexham, so that's the team I've been following most closely over the last few years. Three consecutive promotions.
Well, we will follow closely if there are any developments on that front. Julian, thank you so much for joining. Really appreciate your time this morning. Bonnie, with that, I'll throw it back to you. That is, of course, Julian Salisbury of 6th Street.
Fascinating interview. Danny Berger, thank you so much. More from Danny in Berlin later on. This is Bloomberg. Time now for our front page news. First, on the New York Times, President Trump ordering an investigation of former President Biden and his aides. The order calls for a probe into whether some of Biden's policies were legally invalid because his aides enacted them without his knowledge. In a statement, Biden made it clear he was the one who made the decisions. Next up, the Wall Street Journal reporting on economists raising questions about the quality of U.S. inflation data. Staffing shortages at the BLS mean fewer price checks for its inflation survey. One economist says that's forcing the Bureau to turn to less effective methods. And the FT leading with big investors shifting away from U.S. markets, many questioning whether more than 15 years of inflows and outperformances headed into reverse after President Trump's tariffs delivered a so-called wake-up call. More next. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. SALT talks. Senate Majority Leader John Thune says GOP senators and President Trump had a positive discussion on the tax and spend bill. Countdown to the ECB. The central bank expected to cut rates for an 8th time as global trade uncertainties persist. And day 2 of Super Return. Don't miss our interview with Blue Owl Global Head of Institutional Capital, James Clarke. That's later this hour. Now let's get a look at markets. Very early going, 4 hours till we start cash trading, but we have S&P futures, NASDAQ futures and Russell futures all pointed higher, at least for now, in the early going. That would make a 4th day of gains this week. Treading water just ever so slightly before the non-farm payrolls report Friday, but it is interesting to see that at least we're not losing ground, having had 3 positive sessions. Now, if you look at yields, very interesting story there. We saw a big drop off during the session yesterday. The US 30-year yield now at 486.14. We had a Japanese bond auction that wasn't as badly received as perhaps expected. Remember that high for the Japanese 30-year at one point was 318. That's all the way down now on the 30-year to 289. So perhaps not as panicky globally in terms of bond market action as we had been expecting. That it's not continuing, let's say. The US has auctions of 10 and 30-year debt next week. That's going to be the next test of appetite. All right, let's get to some stocks to watch now. We get across to Joe Easton. Joe.
Hey, Vonnie. So PVH really the big underperformer in the pre-market in terms of your kind of mid-caps, large caps. So this, of course, the owner of Calvin Klein and also Tommy Hilfiger missing on its earnings last night. A lot of discounting going on at the company trying to get all of that clothing off the shelves, and that is impacting their profit, their bottom line, according to analysts. So that stock, as I say, the owner of Calvin Klein, coming down around 8% in the pre-market this morning. Then in terms of Five Below, so we're down in the value retail, discounting, phone cases, toys, stationery, any kind of cheap goods you're looking to pick up. That one actually better than expected. So the stock today, we're up around 5.4% on Five Below at the moment. That's had a bit of a rough run, that stock as well. So potentially some investors are going to be a bit more happy on that one today. Earnings as well, of course, on that one. Then in terms of Verint, this is in the automation and telecom space, kind of automating the call centres, chatbots, that kind of thing. Really strong numbers out of them as well. So Verint, we're up 22% at the moment on the pre-market, set to be one of the biggest gainers at the open of trading. Vonnie, Verint up 22% this morning.
And of course, we have an IPO in the US later today as well, with Circle going public. Joe, thank you so much. Going to be an interesting day in markets. Well, over in Washington, Republican senators have met with President Trump to discuss ways to fix the SALT cap.
We had a very positive discussion about the path forward on the big, beautiful bill, on the reconciliation bill. And I think it was a reminder that we are all in this together. This is a team effort, and everybody is going to be rowing in the same direction to get this across the finish line. Failure is not an option.
Elon Musk, in the meantime, ramping up his criticism against the bill, writing on X, quote, "Call your senator, call your congressman. Bankrupting America is not okay. Kill the bill." All right, let's bring in Bloomberg's Kevin Whitelaw for more. So, Kevin, John Thune saying positive things, there were good discussions, there is a time limit and so on. What possibly could have gone better in the last few hours than we might have been expecting?
Well, you know, it is interesting to watch Elon Musk sort of unleash his firepower against the bill. You know, now that he's out of sort of his White House role and back sort of at his companies. You know, look, obviously he's upset that the bill doesn't really reflect sort of the kinds of deeper spending cuts that he was looking at. And actually is forecast to add $2.4 trillion to the deficit over 10 years. That's really quite a lot, sort of going the opposite direction from what he talked about. But we also have some reporting that suggests that another thing he's sore about in the bill is that it phases out tax credits for electric vehicles, which obviously impacts the company Tesla, which he is now sort of trying to focus on after a very rough run for the company, which has been very much hurt by his political association with the Trump administration.
And then again, President Trump has reinstated one of the most controversial measures from his first term, Kevin.
Very simply, we cannot have open migration from any country where we cannot safely and reliably vet and screen those who seek to enter the United States. That is why today I am signing a new executive order placing travel restrictions on countries including Yemen, Somalia, Haiti, Libya, and numerous others.
We've seen this before, of course, or something similar. Will there be as much of a backlash this time?
Yeah, I mean, you know, he did do this in his first administration for 9 countries. This is against 12. And so I think everyone expected that something like this was going to happen. So there may not be quite the same level of backlash as there was before. This is targeted, and he does have some reasonably broad authority to act on this. I think what's actually going to be much more controversial going forward is a separate decision he made that's going to prevent Harvard from enrolling new foreign students in the coming year, and I think I think that's where he's on potentially thinner ground in some ways, but definitely going to trigger a much bigger backlash from across the political spectrum.
Kevin, yesterday we know that President Trump and Vladimir Putin had a 1-hour, 15-minute discussion, one that Trump characterized as not one that was going to lead to peace. Do we know any more about any kind of impact the U.S. can have on Vladimir Putin's next actions, or what they might even be?
Well, I think, you know, there were 2 particularly notable things about the readout of that call. And it seems that, one, Trump didn't seem to talk about the possibility of new economic sanctions on Russia. A lot of even his political allies are pushing very hard for new Russia sanctions. Europe wants new sanctions. They really want to find ways to squeeze Russia. But that was absent from this call. He also did say in his readout that Putin indicated that he plans to retaliate against that massive drone strike on Russia's Air Force over the weekend. He plans to retaliate against that, really not offering the usual kind of warning or caution or sort of any kind of admonition not to do that, which is what would have probably been the case under Biden or another U.S. president. So I think there's a little bit of concern that he may not be sort of operating with the kind of efforts to restrain Russia, try to put pressure on Russia that I think others had been hoping for. So a concern that maybe he's simply, you know, easing his way out of this peace process that he had tried to start.
Yeah, absolutely. And later today, of course, meeting with the German Chancellor, Friedrich Merz, as well. Our thanks to Bloomberg's Kevin Whitelaw, keeping an eye on everything for us in Brussels. Staying in Europe, the ECB is set to lower interest rates for an 8th time. Bloomberg's Lizzie Burden is at the central bank in Frankfurt for a preview. So, Lizzie, what are you expecting out of the ECB today? I mean, obviously, we're going to get a cut, right?
Well, it would be a huge surprise in markets, Vonnie, if there isn't a cut from the ECB today, because you've got inflation back below the 2% target now in the euro area. But from here on out is where the outlook gets cloudier. First of all, on the tariff front in the short term, because we just don't know whether the US is going to raise tariffs on the EU from 10 to 50% after that July 9th deadline. We just don't know how the EU is going to retaliate, if it will. Of course, you mentioned that you've got Friedrich Merz, the German Chancellor, in the White House later today. But the other uncertainty is around the fiscal boost in the longer term, this infrastructure and defence spending and the economic impact of that. We just don't have the concrete details around that stimulus. So this is why, alongside the updated forecasts on inflation growth, we're expecting a range of scenarios to be published by the ECB. But the question going forward is, after this cut, do they cut again in July, or do they wait until September after the summer break? Economists expect them to wait till September, but Vonnie, the difficulty is you could confuse the markets in the interim. They could see the pause as an end to rate cuts, and confusing the market is the very last thing that President Christine Lagarde wants to do. So I expect she's going to keep her cards close to her chest at the press conference.
Yes, and try and keep a rein on the narrative as well, because there's a lot of other drama at the ECB that really very, very likely to come up at the press conference too, right, Lizzie?
There is, and it's swirling particularly around Lagarde herself and her future tenure as the president of the ECB. There's speculation that she could go and lead the World Economic Forum, speculation that she hasn't notably denied, because she can say now that she's tamed inflation in the euro area. There's also all of the drama around the Slovak Central Bank Governor Peter Kazimir, who of course was convicted of bribery last week, fined €200,000, and if he fails to pay that fine, could be sent to prison for a year. Now, his term was meant to end on the 1st of June. They haven't found a replacement, but the Slovak Prime Minister Robert Fico has said that he does not intend to support his reappointment, Kazimir's, although Kazimir says that he intends to appeal and doesn't intend to resign. So there's all that drama. They're still trying to fill the vacancy at the top of the Slovenian Central Bank. They've been trying for months. And the European Commission has just recommended that Bulgaria joins the euro area. So if the rate drama wasn't enough, there'll be plenty of sideshows, I'm sure, at the press conference.
Well, it all kicks off in about 2.5 hours with the decision, and then we'll be waiting on the press conference, and you'll be there for us. Lizzie, thank you so much. That is Lizzie Burden there. Coming up, we go back to Super Return. Our conversation with Blue Owl Global Head of Institutional Capital, James Clarke, is up next. This is Bloomberg.
All these stuck assets that were originated when too much money came in, bought at too high prices, and it's indigestion essentially. And this is going to have to work its way through over the next couple of years. It's one of the big themes we're seeing in investing right now, which is resolving these stuck assets bought in a different rate environment that needs to figure it out. The solution could come in many forms. A lot of people have been hoping that some combination of growth and interest rates coming lower was just going to bail them out.
Street Co-CIO Julian Salisbury there speaking to Danny Berger at Super Return earlier this hour. Well, Danny also spoke to James Clarke, Global Head of Institutional Capital at Blue Owl, on the shift in alternatives. Let's have a listen.
I think there's a lot going on. There's been a massive sea change in the alternative space. In fact, what I hear here is less about capital appreciation, which alternatives typically were in the past, and more about capital preservation and income generation. We are in a different space. There has been a 40 mile an hour tailwind since 2010, since the financial crisis. Also, there has been an opportunity where pension funds have not had full allocations to alternatives. That has shifted, okay? The narrative of coming into a fund and doing a fund and then getting out is no longer there. You need to partner with your clients 24/7. You cannot approach it from a standpoint of, hey, we're in market, we're out of market, we're back in market. That doesn't work anymore. You have to remain front and center and be their partner. And you can only do that if you're a bigger organization. We always say at Blue Owl, we don't sell funds, we position partnership.
What happens to the smaller funds then? Because James, there have been a lot of funds that started up in the past. What happens to them if you're not one of the big funds?
I'll be honest with you, if we started Owl Rock, which became Blue Owl, we started in 2015. If we started in 2025, much to the chagrin potentially of my bosses, I would think that there is absolutely no reason for us to exist. I could not begin to approach the institutional market right now with a smaller organization. Remember, the barriers to entry are very low in institutional market. Pick up the phone, try and get meetings. But they are consolidating their partnerships. They only have limited bandwidth, and they want to do it with bigger managers that can tap into different types of strategies.
So what happens when that consolidation occurs? What form does it take? Is it funds buying out other ones? Is it other ones that just cease to exist and start to slowly unwind? What shape does it actually take?
I think you've seen the fundraising environment very stagnant, if not lower. Okay. Now, what I will tell you is in this environment, the bigger institutional managers, or bigger asset managers, should I say, have actually grown. Okay, I can speak to that firsthand. And you look at that and you understand why. The smaller funds, I think, are the laggard in terms of why we're not rounding out the same allocations that we saw in 22, 21. Last year, alternatives were down 14%. The year before, it was 24%. These are tough times to raise capital for a couple of reasons. The denominator effect, a lot of institutions are full on capital. The way that you engage the market is key too. You have to understand it begins and ends with the client's objective.
It's kind of ironic because even though fundraising is challenged in some corners, to your point, the big have been able to fundraise. And it's brought about this concern that there's a lot of dry powder. There are less deals going on because M&A is at a freeze, and the banks are really competing in the market too. Is there an issue of too much capital chasing too few assets?
Look, I think there's a couple of things in your question. Number one, the banks and the private markets can coexist. Remember, the private markets are only 18% of deals financed, okay? The other thing is that there is a I think direct lending sometimes gets painted in different shades of beige. It's kind of like curtains in the 1970s, when in fact it's more of a kaleidoscope like the 1960s. So you don't have to source and sit around and wait for a hot LBO market. There are take privates, there are incremental add-ons. Incumbency is key. 50% of the deals we did last year were incumbent positions. The other thing that I would challenge back, and which I say, is things are episodic. I mean, you saw this on Liberation Day. All of a sudden, there was an exit of the banks. Now, they've come back. Equity market was down 5%. You know, I don't think in April, it was up in May. I think capricious is too strong a word, but unreliable is probably more of a narrative. People want certainty. We say this all the time. They want partnership. So there have been these episodic dislocations. 2018 was one. Obviously, the pandemic was one. 21, 22, LBO market shut, or syndicated market shut, should I say. The IPO market shut. Direct lending was the only game in town, and we did a lot of deals then.
Does that mean that even though the banks are back, there are still scars left, which means they won't fully be able to regain market share? Is that what you're saying?
I think that, again, they can coexist. I mean, when you're looking at when you're a private equity sponsor and you're at portfolio companies, you're looking at different ways in which you can grow your business, okay? But it's also like, what is the constellation of your lenders, okay? Now, they underwrite the deal, the banks, then they pass it out to who knows how many lenders. When there is an issue, and let's be honest, we have to be humble in this world. There are always going to be issues. That's why we have diversified portfolios. It's important to understand who your lenders are. How do you work through that situation? And that's where incumbency comes in.
James, I do just want to end on kind of, you teased it there, this idea that it's really just a very disruptive business environment right now. Where is stress showing up because of that? Is stress showing up because of that?
In our portfolios, they're hanging tough, okay, and doing very well. We have very limited issues in them. Now, no one's omniscient, right? We don't know what the future holds. But the most important thing, and I'll take this back to my original comments, is you can't have your head in the sand, but on the other hand, when you're doing 7-year loans or 15-year contractual leases, or our GP stakes business where we're partnering managers, these are 7-year loans. These are 15 years. This is agnostic to an election cycle, right? We're not in it. We're in it for the long term. Our clients are too, right? Scale meets scale and objective meets objective.
I could push back, though, and say, regardless of the election cycle, though, we're seeing a rewiring of trade, of global business that's going to have lasting implications. So surely there are some business models for borrowers that just are really challenged.
There are, and you have to understand, like as I said before, no one gets it perfect. And if anyone was to come up here and say they got a portfolio of concentrated positions and they're going to nail them all, run the other way. Okay, we have average position sizes of 1%. Our industry diversification's across 30. So yeah, there may be one's challenged, but the important point, it all comes back to preservation of capital. Back in the day, when it was capital appreciation, you'd want to take a little bit more of those bets.
That was James Clarke of Blue Owl speaking to Bloomberg's Danny Berger at Super Return. Coming up, we'll get you set up for your trading day with an ECB decision today and more jobs data. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. More jobs data coming your way with Challengers job cuts at 7:30 a.m. Eastern and then jobless claims, of course, at 8:30 Eastern. And then an ECB rate decision, which comes at 8:15 Eastern, followed a half hour later by President Lagarde's news conference at 8:45. Plus, we get earnings from Broadcom and DocuSign coming after the market. We're just at the very tail end of earnings season. Let's have a look at a couple of micro movers now as we head very, very slowly towards that open. Verint extending double-digit gains after reporting a sales beat as client demand for artificial intelligence grows. Broadcom rising there ahead of earnings after the closing bell today, and Visa, Mizuho upgrading to outperform on that stock, saying the cash-to-card runway in the US still has room to grow. I don't know if that's a good thing for the consumer or something maybe a little more worrying. Let's get a check on the broader markets now. It's just a few hours to go before we get the start of trading in the United States. We have S&P futures pointing ever so fractionally to a positive open. We barely held on to half a point of a gain for the S&P 500 yesterday, so we could be on track for a fourth day of gains for that index. Remember, it's up 1% so far this week. The US dollar index, well, it's pretty much unchanged. We have a weaker yen today. Tiny bit of relief a few minutes ago for the US dollar. And of course, yields-wise, we have the 10-year yield back at 434.73. A little relief after Japan's 30-year auction wasn't quite as bad as feared, and that's sending relief through the global bond markets. The next test of appetite will, of course, be next week for debt sales in the US and obviously non-farm payrolls Friday. That's it for Bloomberg Brief. Surveillance is right ahead. This is Bloomberg.